If you spend any time reading about trading or investing, you probably noticed a pattern. When someone asks, "What book should I read?" the answers they expect are books where a trader or an investor explains in some detail what exactly they did. The rules they followed, the setups they looked for, the signals that told them when to get in and when to get out. And look, I get it. I completely get it. When you're trying to get better at something, you want the map. You want someone who's already made the journey to hand you the directions. But after years of reading these books and then trying to actually use what I read, here's what I've come to believe. The map doesn't transfer. It just doesn't. Not because the authors are hiding anything, but because a strategy is not a recipe that you can blindly replicate. It's more like a response to a specific market, at a specific moment in history, by a specific person with a specific psychology and a specific capital base. When Soros shorted the pound in 92, that was the product of 30 years of a particular way of thinking, meeting very particular set of conditions. You can study it and you should study it, but you cannot copy it. So what can you take from books about trading and investing? That's the question I spent some time with. And the answer I arrived at over years of reading that didn't help and some reading that genuinely did is this. What you can take is a way of seeing, some kind of sense-making skill, a lens through which markets start to make some sense. Not rules and strategies for sure. While this is the first episode we are doing on book recommendations, and there will be more, I wanted to start with the books that actually changed how I look at markets, both as an investor and a trader, and as someone who takes the craft seriously enough to want to keep getting better at it. So 8 books, 3 themes, and a promise that none of them will tell you what to buy and when. I'm Sandeep Rao, and this is indeed gold. As I said, we'll cover 8 books across 3 themes. The first 3 are about markets themselves. What they are, how they work, and how some of the sharpest minds have looked at them very differently. One builds a theory, the next challenges it, and the third explains what's actually going on underneath. The first book is Capital Ideas by Peter Bernstein. If you want to understand how modern finance was built, the actual ideas and the people behind them, this is the book. Bernstein was both a practitioner, a second-generation investor, and a historian, all of which gives him some kind of gravitas. The book tells the story of how big ideas in finance, portfolio theory, the efficient market hypothesis, options pricing came about and how human and accidental it was. They were made by specific people in specific circumstances, often against enormous odds. Take the story of Alfred Cowles. Cowles was a wealthy man from a newspaper-owning family who came down with tuberculosis in his 20s and spent a decade recovering in Colorado Springs. To pass the time, he subscribed to investment newsletters, the kind that promised to tell you what the market was going to do and which stocks to buy or sell. When the 1929 crash wiped out fortunes and not a single service he followed had seen it coming, the simple question that he asked was, can anyone actually predict stock prices? What followed was one of the most obsessive research projects in financial history. He analyzed 7,500 recommendations from 16 financial services, every transaction made by 20 leading insurance companies, and 3,300 recommendations from financial publications, cross-referencing all of it against what the markets actually did. His conclusion, published in 1933 in just 3 words: it is doubtful. Wall Street ignored him completely. Investors kept subscribing, advisors kept publishing, and the business kept growing. In 1944, he published a follow-up covering 6,904 forecasts over 15 years. Same result, same silence. Cowles understood exactly why nothing changed, and he was honest enough to admit he couldn't fully escape it himself. In his own words, people are still going to subscribe to these services. They want to believe that someone really knows. You see, a world in which nobody really knows can indeed be frightening. Referring to his personal life, he said, "I don't come to belief easily. I'm an agnostic married to a Christian scientist. She's tried to convert me, of course, and I want to believe, but I can't. Now, all that was written decades ago. Scroll through financial Twitter or business news channels today and tell me if anything has changed. The second book is The Alchemy of Finance by George Soros. In India, Soros is someone you probably know for other things than his investing. But before all of that, he was one of the greatest macro traders who ever lived. The central idea of the book is something Soros calls reflexivity. You see, the conventional view is that prices reflect an underlying reality. Soros says prices don't just reflect reality, they shape it. Beliefs alter fundamentals, fundamentals alter beliefs, endlessly feeding back on each other. In the book, he illustrates this with the conglomerate boom of the late 1960s. A few companies figured out that if your stock trades at a high multiple, you can actually acquire companies at lower multiples and automatically inflate your earnings per share. Once the market rewarded this, the process becomes self-reinforcing. Higher prices means more acquisitions, which inflated earnings further, which justified even higher prices. Investors, in Soros' own words, responded like Indians to firewater, until they didn't, and the whole thing ran violently in reverse. So when he said Indians to firewater, he was actually referring to Native Americans, and firewater here means some kind of alcohol. So yes, Soros made money on both sides of that trade. And then he did the same thing again with real estate investment trusts. The line that stayed with me from the book was this: markets are always biased in one direction or another, and markets can influence the events they anticipate. In other words, the rising price of a stock doesn't just reflect a company's prospects, it can actually improve them. So the map can change the territory, sort of a thing. That is the alchemy of finance. Once you see things from this lens, you cannot go back. The third book in this theme is Narrative Economics by Robert Shiller. If Bernstein built the theory of markets and Soros explained why prices shape reality, Shiller asks the next question: how do beliefs actually spread through millions of people at the same time? His answer: stories. Contagious narratives spread through populations exactly like viruses. And that is what moves the markets. On a side note, a friend of mine who studied at Yale and took Shiller's classes said for such a fascinating topic, he was an extremely boring professor. Anyways, back to the book. One story from the book that I remember is this. In 1974, economist Arthur Laffer supposedly drew a curve on a dinner napkin at a Washington restaurant to explain to journalist Jude Wanniski and two powerful White House men, Dick Cheney and Donald Rumsfeld, as to why cutting taxes would actually increase government revenue. The story was published in 1978, went viral, and what followed was the Reagan administration reducing the top US federal income tax bracket from 70% to 28%, and the corporate profit tax from 46% to 34%. And that napkin? Well, it's preserved at the Smithsonian National Museum of American History. There's just one problem though. Laffer himself denies the whole thing. In his own words, he says, "My mother had raised me not to desecrate nice things." But Shiller points out, Laffer's honesty could not stop a story that was too good to be stopped. And that is Shiller's central point. It doesn't matter whether the napkin episode actually happened. The story of the napkin exists. And stories, it turns out, behave exactly like viruses. They spread, they mutate, and they change the world whether or not they are true. That brings me to the end of the first theme, and here's what these three books are really saying together. Bernstein shows you how the dominant theory of markets was built. Prices are rational, markets are efficient, everything is discoverable if you have enough data. And then Soros goes on to crack that very foundation by saying that prices don't just reflect reality, they create it, and markets are never truly in equilibrium. And finally, Shiller explains the mechanism that drives the whole thing, and that's stories and narratives. That is, viral narratives spreading through populations that form the collective beliefs, which then move markets. Anyway, Bernstein builds the megastructure, Soros shows us why it's unstable, and Shiller tells us why people still continue to live in it. So now that we understand how markets behave, or perhaps, if I have to be more accurate, how they misbehave, the next question is, how do you actually operate inside them? How do you think clearly, make better decisions, and find a genuine edge in a world that is largely reflexive, narrative-driven, and deeply, deeply uncertain? The next 3 books are about exactly that, and together they form what I think is the most honest answer available to that question. So with that, we get to the second theme and the fourth book. We will start with A Man for All Markets by Edward Thorp. Thorp was a mathematics professor who decided to treat both the casino and the Wall Street as problems to be solved. He started with blackjack. The conventional wisdom was that the house always wins. Thorp refused to accept that. He used MIT's IBM 704 computer to run the calculations, sharing computer time with 30 other universities, waiting for days for results, and eventually proved that by tracking which cards had been played, a player could shift the odds in their favor. He then published the system in a book called Beat the Dealer. The casinos actually had to change their rules in response. But here's a more interesting story as to what happened when he moved to Wall Street. He figured out how to price warrants and options independently, and years before Black-Scholes and Merton published the formula that won them the Nobel Prize. Instead of publishing it, he used it for himself. His fund, Princeton Newport Partners, ran for nearly 2 decades, compounding at 22.8% annually before fees, with no losing years and no losing quarters. And then there's the Madoff story in the book. In the spring of 1991, Thorp was hired to review a client's hedge fund investments. When he looked at Madoff's numbers, smooth monthly profits, no losing months, even when the strategy should have produced losses, he got suspicious. He asked to visit Madoff's operations, and Madoff's brother turned him away at the door. So Thorp did what he always did. He ran the numbers. For more than half of the individual option trades he reviewed, no trades had occurred on the exchange where Madoff claimed they took place. For many of the rest, the quantity Madoff reported for just his clients' 2 accounts exceeded the entire volume reported for all market participants combined. He then told his client in simple words that the trades were fake and this is fraud. His client closed his accounts with Madoff, and that was 1991. Madoff confessed in December 2008, 17 years later. The Ponzi scheme at its peak was estimated to be at $65 billion. The 2 key lessons I take away from this book is 1. Genuine edges exist, but finding them and sustaining them requires far more rigorous work than most people are willing to put in. And 2. When the numbers contradict the story, always go with the numbers. After all, Thorp spotted Madoff 17 years before the world did. That brings us to the 5th book, which is The Drunkard's Walk by Leonard Mlodinow. The central argument of the book is that we are spectacularly bad at understanding randomness, and this failure costs us more than we realize. Here's the story that opens the book. In the mid-1960s, Daniel Kahneman, who would go on to win the Nobel Prize, was asked to do something quite routine, and that was to lecture a group of Israeli Air Force flight instructors on behavior modification. His basic argument was reward good performance as punishment doesn't work. One instructor interrupted him. I praised people warmly for beautifully executed maneuvers, and the next time they always do worse. But I've screamed at people for badly executed maneuvers, and by and large the next time they improve. My experience contradicts everything you're saying. Every other instructor in the room agreed. Kahneman sat with this for a moment, and then it struck him. The screaming preceded the improvement, but it did not cause it. After an exceptionally bad landing, the pilot would almost certainly perform closer to his normal level the next time. Not because of the screaming, but because extraordinary performances, good or bad, are almost always followed by more ordinary ones. That's regression towards mean or mean reversion. The instructors had been taking credit for something that was happening on its own. This one insight from one interrupted lecture spurred 30 years of research with Amos Tversky into how human judgment fails under uncertainty. Research that eventually won Kahneman the Nobel. The 2 lessons I take from this book. 1. We constantly confuse outcomes with causes. In other words, correlation is not causation. Second, extreme results in either direction should make you more cautious, not more confident. Just the way it happens in trading, where after a big win or a big loss, your result mostly reverts to the mean. So don't get too complacent or take the big loss to heart and trust your system. The sixth book in this series is The Signal and the Noise by Nate Silver. Silver is a statistician who became famous for predicting election results with unusual accuracy. But this book is not really about elections. It's about why most predictions fail and what separates rare ones that don't. So there is this thought experiment in the book that I find particularly useful for anyone thinking about markets. Silver uses a simple example to explain Bayesian reasoning, the statistical framework that sits at the heart of good prediction. Let's say you come home from a business trip and find a strange pair of underwear in your drawer. Your mind wonders, what is the probability that your partner is cheating on you? Most people would react emotionally and immediately at this moment. But Silver, being a Bayesian, says one should slow down. The answer depends on three things. How likely is it that the underwear would appear if they were cheating? Second, how likely is it that the underwear could appear even if they were not cheating? Say a friend stayed over, luggage or laundry got mixed up, any of that. And most importantly, what did you believe about your partner's fidelity before you found the underwear? The third question, what you believed before the new evidence arrived, is what Bayesians call the prior. And that's the key. And Silver's point is that most people in markets and in life ignore it entirely. They see a piece of evidence and react to it as if they had no prior beliefs at all. Now let's look at markets from this perspective. Say a stock falls 5% on a news event and suddenly the bull thesis is dead. Quarterly results come in slightly below expectations and suddenly the company is broken. Good probabilistic thinking works a bit differently though. One, you hold a prior belief. New evidence arrives. You update but proportionally in line with how strong the evidence actually is. You don't abandon the prior on every new data point. But you don't ignore the data to protect a thesis you already committed to either. The forecasters who get better over time are the ones who do this consistently. And that's the key takeaway from the book. So what are these three books really saying together? Thorpe shows you that genuine edges exist, but finding them requires rigorous work, and sustaining them requires the discipline to trust your mathematics even when the story around you is saying something else. Melody now shows you why that discipline is so hard to maintain, because your brain is actively working against you, seeing patterns that aren't there, confusing outcomes with decisions, and mistaking luck for skill. And Silver shows you what the corrective looks like. Hold your beliefs, update them when evidence arrives, and do it proportionally rather than violently. Together, these three books make one single key argument. If I have to say it in the context of the markets, it is this. People will always generate a more emotionally compelling story than the data. The edge belongs to the person who can hear the story, acknowledge it, and still go with the numbers. Now over to the last theme. These two books are not about markets at all, at least not directly. They are about the longer game. How do you actually become someone who can do things well over years and decades? Both books are asking the same question. What does it actually take to get genuinely good at something? Green's answer is that mastery is a long, structured, often painful process, and that the intuition great practitioners seem to have is not a gift. Newport, on the other hand, has a slightly different take and is rather critical of the follow your passion trope. He says passion is hard to identify in advance and for most people has nothing to do with the work. And more importantly, passion is not something you find overnight and then follow. Instead, Newport argues that passion is a side effect of mastery. Competence generates passion, not the other way around. I find it very logical. You see, it doesn't take any effort to be passionate. You may see a few Instagram reels about a cafe in the mountains and you may feel passionate about opening one. It doesn't really speak about the real skills or the competence needed to run that cafe. Yes, one last thought before I go. In markets, as in most things in life, we sometimes tend to believe our ideas are original, that we figured something unique. Over time, what reading widely has taught me is that almost everything we can think of as new has already been studied. Maybe in a different field, a different era, or a different context. The problem we are wrestling with today was probably wrestled with way before. So reading books, apart from giving us frameworks, also humbles us. And humility, it turns out, is one of the most underrated edges in this business. We all, whether we know it or not, are standing on the shoulders of giants. And these 8 books are a good place for you to start your climb. And that brings me to the end of this episode on book recommendations. I hope you found this episode useful. And if you have any questions, feel free to drop them in the comments. I'll be happy to respond. Till then, take care, trade safe, and I'll be back soon with the next one.